G'day guys and welcome back to the channel. We've got some really big news to discuss today. We've got two big stocks on the ASX which have had massive swings in their price. Those two companies are A2 Milk and Piedmont Lithium Limited. We've seen Piedmont announce a deal with Tesla and we've seen A2 Milk release an updated earnings forecast. These two small bits of information have had a massive impact on the share price of both those companies. A2 Milk has unfortunately seen their price take a hit. However, Piedmont Lithium has seen their share price go up almost 400%. So what was the reasons for this? Well, stay tuned. I'll get right into the details and explore exactly why both price movements happened. Don't forget to subscribe to the channel if you're enjoying the content and give the video a big... Don't forget to subscribe to the channel if you're enjoying the content. And also make sure you give the video a big thumbs up. As always, this video is not professional financial advice. Before making any investment decisions, make sure you do see a qualified financial advisor. Right guys, with that out of the way, let's jump straight into it. Let's first talk about A2 Milk. A2 Milk has released an earnings update which shows their forecast revenue is going to drop in the first half of 2021. This is very unusual for the company because A2 Milk has over the past 5 years shown some really strong growth, which has driven their share price up to almost $19 in the recent past. As a result of their earnings forecasts, we've seen their share price drop down to around $14 now. I mentioned in the last episode I was watching A2 Milk closely and waiting for a buy-in opportunity. I mentioned that I was still wary of the effect that China could have on A2 Milk. However, I would be interested in the company at the right price. And it seems like the right price might be coming up sooner than I expected. So why are we seeing a drop in A2 Milk's earnings? The reason is pretty simple. It's to do with the Daegu export channel. I hope I'm saying that right. If I'm not, let me know in the comments. So what are the Daegu? The Daegu are Chinese professional shoppers. There's two ways they operate. They either live in the foreign country that they're shopping in, such as Australia, or they live in China and they fly in and out of a country. What they do pretty simply is buy products and send them back to China. Usually the products that these professional shoppers source from foreign companies are either hard to come by in China or they're more expensive back home. This enables the Daegu to charge a fee for the products they buy before they send them back to China. These professional shoppers make up quite a large proportion of A2 Milk's sales. A2 Milk is seen as a premium brand in China and is therefore highly sought after. As I understand it, it's also quite expensive there because of the short supply. This makes it a lucrative product for these professional shoppers and therefore the trade has been booming in recent years. Since COVID-19 has come along, there's been restrictions imposed, which has made it near impossible for the Daegu to operate. This has influenced not just the fly-in, fly-out shoppers, but also those who live in Australia and post products back home. Some of the restrictions include store closures, curfew hours, increased shipping times, and obviously the ban on international travel in and out of Australia. All in all, this has led to a major drop in revenue for A2 Milk. Will this system recover? Yes, probably in the future, although it's definitely a wake-up call to A2 Milk that they shouldn't be relying on this source of revenue as much as perhaps they have been in the past. The CEO of A2 Milk has come out and said also that he thinks this is just a short-term issue and things should return to normal once the COVID-19 situation in Australia is brought under control. Whether or not this turns out to be true, I still think A2 Milk is a very strong company and they've proven their ability to grow their profit margins and also their sales growth year on year. I think if their share price gets any lower, it's definitely a company I'll be considering purchasing. We also know that their forecast full year 2021 results will be positive, although the growth won't be as good as it has been in the past. What's your position on A2 Milk? Is it a stock that you'd like to jump into, or are you still cautious considering the geopolitical tensions between Australia and China? I'd love to know. Let me know in the comments section below. Okay, let's move on to the big story of the week. Let's talk about Piedmont Lithium. Now, I for one will be the first to admit that seeing the share price jump in Piedmont Lithium was certainly a surprise. I think everyone's attention has been focused on Novonix over the past few weeks this has definitely slid under the radar. As you may have heard, Tesla has announced a supply deal with Piedmont Lithium. This is all well and good, but I thought I'd take a bit of a deeper look at exactly why Tesla chose Piedmont Lithium. This is a company, after all, that has been performing pretty poorly on paper for the past few years. Certainly, when I had a look at the company on face value, it didn't make a lot of sense to me exactly why Tesla would choose to partner with this company. They're not profitable. They've had really poor revenue growth. It's actually going backwards. I'll put up a screenshot of the Simply Wall Street analysis of this company, which just shows warning signs left, right, and center. We're seeing things reported here like the company is not forecast to be profitable within the next 3 years. And from my perspective, that just doesn't make a good investment. Unless you're really confident about some kind of long-term prospects for the company, I can't see why you would invest in this company without any profits in sight. So from this analysis, it doesn't make sense to make an investment. So why has Tesla put their trust in this company to be their sole supplier of lithium? Well, that took a little bit more research, but I think I've discovered the reason why this might be the case. So the first telltale sign about Piedmont Lithium was the insider trading. There were some articles I found that talked about the insider trading over the past 6 months up to a year. We have seen that insiders have been buying a huge amount of Piedmont stock. In addition to this, we are not seeing any insider individual selling in this company whatsoever. This is a strong sign, but it still doesn't explain why Tesla is so interested in this company to produce lithium for them. So what's the company's goal? Well, Piedmont wants to be a lithium producer. They want to mine lithium out of the ground. In addition to this, they also want to process what they bring out of the ground and transform it into lithium hydroxide, which is done at a chemical processing plant. This is not always done under the same roof or under the same company. This would be a unique proposition, and it would give Piedmont total control from bringing the mineral out of the ground all the way to processing it to the point where it is ready and battery grade. So that's point number one. They've got an integrated mining and manufacturing solution. So the second big point to consider about Piedmont Lithium is the location of their mining operations and also their proposed processing facilities. So where are they planning on setting up? Well, it's in the same place they've been doing testing over the past few years to confirm the exact amount of lithium that's in the ground. And this is in North Carolina. Why is this significant? Well, it's inside the United States. Tesla is obviously keen to source lithium internally from the United States. It means that one, they reduce their reliance on overseas suppliers, especially China, which is one of the world's biggest lithium producers. It also gives them tax benefits that they wouldn't be able to access if they had been bringing in lithium from overseas. We know that Albemarle Corp is the only other American lithium producer, but they're not producing in this same region. And they're also not combining the two processes together. The only place that does that, which mines it and then processes the lithium into lithium hydroxide, is in China. So for Tesla, there's no one currently out there who can deliver exactly what they need inside the US. So what about other competitors in the lithium industry who are focusing on this North Carolina project? Well, there are a few. We know that Lithium Americas and Ioneer are both planning on exploiting the same bit of land in North Carolina in order to extract lithium. So why did Tesla choose the Australian listed Piedmont? This is the one detail I couldn't get to the bottom of, but I think it is probably reason number 3, which is price of the product. When you have a look at Piedmont's last annual report, you'll see they heavily focus on the end cost of the lithium that they plan to produce. It should be mentioned that Piedmont hasn't produced a single bit of lithium to date. They're not in commercial production yet. Piedmont are forecasting that with their manufacturing process and mining process, they should be able to achieve some of the cheapest lithium in the world. Piedmont themselves, in their annual report, boast all the benefits of their mine proposition. They believe their project has compelling economics because of a long mine life, low operating costs, low corporate income taxes, and minimal royalties. So these reasons altogether have obviously been convincing enough for Tesla to want to sign up to this agreement. And this is all being done in the US with the tax benefits that are available. And this is why this is number 3. I think the main reason Tesla has gone for these guys, they've ticked all the other boxes, and I think they are probably going to be the cheapest supplier of lithium in the US. It should be mentioned that the deal Tesla has signed with these guys the price for the product has not yet been revealed. I think this will definitely be the critical point of the deal, and it will show exactly why Piedmont has been chosen as the preferred supplier. Having said that, we also know Tesla hasn't fully committed. They have an option in the deal to buy in more and take more of the supply, but for the moment they're starting at a lower percentage of the total output that Piedmont plans to produce in North Carolina. So I think putting together all of the facts, we can see why Tesla has chosen this company as their preferred supplier, or we can speculate why that is probably the case. As for the share price, it's really difficult to tell what this company should and shouldn't be worth. Considering they have not produced any profit to date, it's quite difficult to do a value analysis. This is certainly one I'll be watching going forward. I'd love to hear your thoughts on the company. Maybe you've got some more to add. Maybe you're buying in at the moment. Let me know. It's pretty exciting times. It's probably the first big lithium deal we've seen from an automotive maker. So I'd like to see how this one unfolds going forward. Anyway, that's all from me for now. Thanks so much for joining me again. Don't forget to subscribe and give the video a like if you enjoyed it. Until next time, guys, stay safe and I'll catch you in the next one.